Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Season 7 of Talking with Traders. We're now into the fourth year of this podcast since it started in early 2020. Once again, IG have come on board as our sponsor for this season. We are truly privileged and grateful to have such a global leader in CFD trading as our sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some will be follow-ups with past guests, and some will be new guests. The idea behind this podcast is that you get a variety of views from a broad spectrum of market professionals. None of what you hear in these episodes is intended to be financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here into your own trading and investing. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified when new episodes are released. Once again, thank you to IG for funding and sponsoring this podcast into its fourth year. And thank you, listeners, for tuning in. Please enjoy Season 7 of Talking with Traders. Welcome back to another episode of Talking with Traders. And this episode is for listeners who like financial engineering. If you like the idea of guaranteed US dollar returns, this is the podcast for you to listen to. My guest is Brian McMillan from Investec Securities. Brian, welcome to the podcast.
Thanks very much. Thank you. Yes, not exactly Traders Corner, this one. No. We're more on the investment side. And it's Investec Bank Limited. So
Investec Bank, not Investec Securities. My apologies.
Yeah, no problem.
Super. So as I said in the intro, Brian, this is going to be all about structured products and guaranteed US dollar returns, etc. You've got an exciting new product that's out there at the moment, one of many products that you guys have released over the years, which have been pretty good by all accounts, and we'll talk about that later in the podcast. But you mentioned this is more about investing and less about trading, which is absolutely the case. However, it is always interesting to talk about different products and also get people's views from different aspects of the market, be that trading or be that investing. And what I'm particularly excited about speaking to you about today with this is the financial engineering aspect of it and the products or the back end products that go into making these structured products. But I guess a good point to start with is just to ask you, very simple, back to first principles, what is a structured product in the context of what you guys are selling here?
Yeah, sure. So, structured product has such a broad name. I think in South Africa, most people have seen structured products that are offered to retail clients. And they generally are equity-linked investments. And they're sort of characterized by the fact that they have a capital protected component to them, whether that be 100% capital protected or protection subject to a barrier on the downside. But generally, when the South African investors looking at structured products, they're thinking about equity linked and with some level of capital protection with it.
Okay. So now this latest product that you've got is called the Optimal Investment Growth Basket. And clients, investors can subscribe to it. I think the deadline is 24th of November, 2023 to subscribe for this one. But let's just talk about this product at a high level quickly. And I want to ask you a couple of things like the constituents of the basket, the term of it. Just give us a bit of those details around this basket so that we can get a high level picture of what it looks like before we then start talking a little bit more about specifics.
Yeah. So the general premise of this is that it's a 5-year note, and we'll go into reason why it's 5 years long. It's actually structured as a share, so not a note, it's a share. The investment lasts for 5 years, and it's 100% capital protected in US dollars. So if the indices that's about to tell you about don't perform over those 5 years, the investor will get their capital back at the end of the term. The indices that we're talking about are put together in a basket, and essentially what we're doing is we're forming an index out of 4 different indices. So you have the S&P 500 at 40%. You have the Euro Stoxx 50 at 25% weighting. And then we have the Nikkei 225 at 20%, and 15% is made up of the MSCI World Emerging Markets Index. Now, that Emerging Markets Index is heavily weighted towards India and China. So not a lot of South Africa in there, but it does have a small component of South Africa. So altogether, that basket actually mimics quite well the MSCI World Index, but it's not exactly the same. And what we've done is in the MSCI World Index, the weighting in there of the S&P 500 would be over 50%. What we've done is we've looked at these and said, the S&P is looking a little bit top heavy at the moment, mainly because of those, the Magnificent Seven, the AI or the tech shares, which are pushing up those valuations. So we've pulled that back a little bit, put a little bit more into Euro Stoxx, a little bit more into the Nikkei, and kept the Emerging Markets Index at 15% there.
Okay.
And that altogether forms the basis for the returns there. And so that will be whether that basket is up, you will get a return of 1.5 times whatever that index does or whatever that basket does. You will get, if it goes up 10%, you will get 15. Because it goes up 20%, you will get 30%. So we have this geared upside and no downside. And I think that's really the basis for a lot of the appeal in these structured products is, you have the chance to make more than the index on the upside and preserve your capital if indices are bad over the next 5 years. And where we are at the moment, the outlook is certainly a little more uncertain than we've seen for a number of years.
Yeah, absolutely it is. It's very attractive. You mentioned the 150% gearing to the upside, but that is also capped, isn't it?
Yes. So that's another thing about structured products is it's always a give and take. Because you have this downside protection, you have to give away some upside. So what we've done here is we've capped it. It looks like it's going to be capped around about 40%. And so growth of the basket of 40%. But because you're earning 1.5 times that 40%, if the indices do go up 40%, you will get the maximum return being 60% at that point. Okay. So what we're kind of saying here is that we think equity markets over the 5-year period will grow, but we don't see them shooting the lights out and going up 70, 80%. If they go up 30%, then you'll get 1.5 times that. If they go up 40, you'll be at your maximum. And we've looked at it, historically as well, and most of the returns are around about that, over a 5-year period, are around about that 30, 40, 50% level.
Right.
So that in this case, it works out to 9.8% annualized if you got the maximum return at the end of the period.
Yes. Okay, that's very attractive. Okay, so capital guaranteed, you can't lose money on this thing in US dollars. Your maximum upside is going to be 60% return, assuming that your underlying basket does 40 or more. And just to clarify that, I mean, if the basket did do, let's just say, I don't know, 100%, but highly unlikely, as you've said, but if the basket did 100% over the 5 years, your return is still going to be capped at 60 based on the way that the structure is done. Okay. All right.
And then the one other thing that we always kind of talk about, your capital is protected, but that's subject to credit risk. So we always say, it's subject to credit risk. What you are doing is you're giving, your money to one of the biggest banks in the world. So there's always the chance that those banks could go under. So we never say guaranteed, but the banks that we link these to are always A-rated banks with very big balance sheets. And in this particular case, we're going with some big bank names, and it's credit linked to another 3 names there. I'm just making 100% sure here. So this particular one will be Morgan Stanley, big American bank, and then it has 3 credit references underneath that. We can unpack that sort of thing when we talk about how we work the capital protection.
Okay. All right. So the point is, like, yes, there is some counterparty risk, but the counterparty are those big 3 banks. And if those kind of banks go under, well, we've got bigger problems in our lives than. Yeah. Okay. All right. And there's a minimum investment amount for a retail client to participate in this, right?
Yes, that's correct. So because we actually started this investment over 15 years ago, the first ones were around about 12,000 rand, $1,000 per share. And what's happened is over time that share has actually increased over time. Over the last 15 years, the last 3 products, this is the 4th iteration of it. And so those shares, each share is now $12,000 at the moment. And that would be your minimum investment amount. Yeah.
So $12,000 is the minimum. Okay. All right.
Now
Indeed. You mentioned that it's a listed share, or it's traded as a note. Just explain that for us, if you would. I mean, I know a note is obviously it's a product that you take counterparty risk on, which we've discussed. But is it liquid? Where does it trade? Is there a reference price daily that investors can see?
Yeah. So we have a number of different types of structures. We, as a bank, Investec Bank Limited, list notes on the JSE. We also list notes in Dublin. This particular structure is actually very unique in that it's actually a share structure based in Guernsey. And it has a number of advantages. The first one is that because it's based in Guernsey, the company itself pays no tax. So we essentially put the structured product inside this company. You buy a share in the company. In 5 years' time, let's hope the market goes up. Let's say it goes up 45%. You'll get the maximum return of 60. And at that point, we will come back to you and say, why not invest in our new product? Might be slightly different weighted. It might be the S&P 500 only for a further 5 years, but you don't have to sell your shares at that point. So we put the new structure inside of those shares. You can, at that point, continue to hold that share. And having never sold it, obviously, you don't pay tax until you sell a share finally. But the other major advantage is that, once we put the new structure inside, we rebase that capital protection up. So, where you now put 100% in, you now have 160, and your capital protection is from 160 now for the next 5-year period. And that's been very powerful because, we started these in 2003, issuing these company structures. And it's only now, once we've done 3 or 4 of them, 15, 20 years later, that we realize how powerful that is for somebody who stays in. Because they keep rebasing their capital protection, but they never sell the share. And one of the really amazing things about our products is how many people stay in the products. The retention rate is really good. So people have had good returns. Obviously, that's the first thing they want to see. But secondly, they get higher and higher capital protection as they move down the line.
Okay. All right. Fascinating. Yeah, because that was going to be one of my questions. If you had have rolled over these products from one iteration to the next, you must have done pretty well over the years.
Yeah. And I mean, it works the other way when the market's down. After 5 years, which we had in, I think, only 1 or 2 of our products. In 2000, we started them in 2007. By the time they expired in 2011 and 12, the market was down, you got your capital protection, but now the market's at a lower level and you reinvest at that level, So a number of advantages with staying in them over time.
Yeah, fantastic. So we talk about staying in, obviously that's the benefit, and holding the product to its maturity, of course, is first prize in terms of being able to extract the maximum possible return out of it. But we know that sometimes life happens, people die or get divorced or whatever, or they have some sort of urgent need to liquidate their investments. Is there liquidity available in this product should somebody need to get out before the 5-year term is up?
Yes, very much so. And, Garth, you would have remembered 2002, 3 in the South African market, I think with your old shop, actually. They came and brought some structured products in. They were one of the French banks. And, they sold it into the market and then disappeared for 5 years.
Yeah.
Nobody knew how to phone them, get them. And one of the things that we've made very clear when we did these structured products is we want them to firstly be easy to buy, easy to hold, and easy to sell. So, the purchase process is quite well known amongst the IFAs in South Africa. You can hold them on a platform, you can hold them on a stockbroking account, you can hold them on a custody account. The second thing is that we want to be able to give people a daily mark-to-market price. So the ones that we list on the JSE, we've got a bid offer, certainly a bid on the screen at all times. And that was another thing that just kind of brought people along and made them more comfortable with structured products, because once they could see there was a daily price, and they got their accounts, the monthly statements, they could see, that value has gone up or it's gone down. And that just gave another level of comfort. And then, of course, the third thing is can you trade them? And, our JSE ones, for example, we trade them quite often on the JSE. People phone us up and say, I want to sell, 1,000 units. We go bid on the screen. And with our Guernsey products, we make a market as well. So people come to us. It's not a live market like the JSE. You can't, go in and just put your offer on. You phone us, but we do buy back those from the clients, and that's at the prevailing price of that product. So they're also very easy to hold. And what we realized was over time was if you make markets available to people where they can see the prices of these, whether it's on the JSE or on a web page that we produce on a daily basis, it gives people comfort to actually hold these. And we've been able to do that over time, make sure that investors know on a monthly basis when they get their statement that they can see the price of these, they can see them moving up or down. And then lastly, of course, is the ability to actually sell them. And we do that, our JSE listed notes, you can actually trade. You've got a share code. You can see that we're bid in the market. The brokers know that if they want to do larger size, they phone us up. We go bid on the screen. We match them there. With our Guernsey products or these offshore shares, we make the market ourselves. So people phone us. We'll tell them what the price is, and we actually make a market in those. And that market is normally, we take the mark-to-market price, which we can go into how we make that up, but less a 1% spread. So it's not that punitive in terms of unwinding as well.
Okay. All right. That's good to know. All right. So I think that's great, Brian. We've got a good understanding of how the product, works from an outcomes perspective. What I'm most interested in here, being a trader and having dabbled a bit in options and derivatives all my life, is to understand a little bit about the inner workings of this thing, because you've got 100% capital protection, which is great. You've also got a cap on the upside. So my sort of amateur options trading background tells me there's probably maybe a put option in here and a written call out the money at a 40% higher up or something like that. But I mean, perhaps it's not as simple as that. Can you give us a bit of a background into the inner, without giving away the secret sauce, I guess, although the secret sauce is not that easy to attain as a retail investor anyway, I guess. So let's understand the sort of the inner workings.
No, we're very happy to be very open with our, the way that we structure these products. So, and it's, the more we are, the more people, look at it less as, some sort of witchcraft and more of the investment product that it is.
Yeah.
So the structured products, as I said, they've all got a couple of things in common. One of them is the fact that they have a term. So, these products, the optimal is 5 years long. And what that means is that we know as a bank that we're going to have your money for 5 years. Now,
right.
Obviously, some people, disinvest, but for the most part, and we find 93% of people hold it to term and in fact roll it over. But so as soon as we know that we have your money for a 5-year period, what we do is, so a client gives us $1,000 US. We take that $1,000 US, and the first thing that we do is we go to our funding desk and we say to the funding desk, we have $1,000. We want to give the client back $1,000 in 5 years' time. How much do I have to give you today in order for it to grow to $1,000? So, we essentially PV or we get the present value of that using current interest rates. Now, in this particular case, what we're doing is we're actually giving that money to Morgan Stanley because they are providing us the credit. And they would say to us, if you give us 72% today of that $1,000, that will grow in 5 years' time back to $1,000. So right. you give us $720, we'll give you $1,000 back in 5 years' time. That allows us then to have the balance then. And what we do with that is we actually split it into fees and optionality. So the first thing is, we as the bank in this particular case, we earn 60 basis points per annum on this particular structure, which is 3% over 5 years.
Yep.
And we do that. We only take that out of the price on an annual basis. So we don't take it all out up front. We then, because we're selling this to through the advisor market here in South Africa, we also pay them 60 basis points per annum, or another 3%. And then the cost to run the company for the 5 years, we have auditors, we have to set up audit directors, all of that in Guernsey, that's around about 1%. So 7% is used for fees. 72% is given to Morgan Stanley to provide us with the capital protection in 5 years' time. And that leaves us with 21%. And what we do with that 21% is we go to about 7 or 8 different banks, all international banks, all A-rated, because again, you don't want the credit risk of them not paying you your option out. And we say to them, we want to buy 1.5 times call options. So what that means is you have the gearing of 1.5 times if you buy 1.5 options. And how much does that cost? Now, they might come back to us and say, that will cost 30% of your $1,000. Well, we say, well, we only have 21% to spend. And at that point, that is where the cap comes in. So they will say, okay, we will sell another call option higher up. So, and in this particular case, it looks around about 40%. So we buy 1.5 time call options at 100%. So we have the money, and as soon as the market goes up, you start making 1.5 times whatever the market goes up. And then we sell them at 40% higher, and that's where it's capped out. So it's really a 1.5 times call spread is what we're buying there for the trader minded.
Yeah.
And all of that put together makes it quite neat, because now you've bought an investment where all fees and costs are worked into the product. All fees and costs are well known by all the investors. There's no hidden costs. There's no costs that the client will actually have to pay extra at expiry or anything like that. So, the client knows that if that particular basket goes up 20%, they're going to get 1.5 times 20% or a 30% return. And that cleanliness, makes it quite nice for the investor, because it tells you up front what's going to happen.
Mm. It's fascinating. Okay, so it's very interesting. So that answers the question effectively. As you say, you've got a call spread. You've bought an at the money call, and you've sold a 40% out the money call, 5 years term, and that's where the return comes in. And there is the leverage aspect of it because of the fact that you bought a 1.5 times call. I mean, I guess I'm just thinking aloud now. As an investor, you could effectively gear that up yourself, being an investor, by borrowing some money and then putting it into this product. Of course, then you do have the funding cost, but and that then it becomes the investor's risk.
Yes, very much so. And so, we've seen people do that. They use carry accounts on stockbrokers' sites, or they borrow money. We used to see it a lot more, I think, when interest rates were very low.
Yeah.
US interest rates were close to 0% for the last 10 odd years, until inflation reared its head. When you've got the maximum return will kind of work out to an IRR of 9.8%. So you don't want to be borrowing at anything over 4% to gear that up.
That makes sense. That makes absolute sense. So, I mean, it looks to me like, as a retail investor, I suppose one could, in a way, go out and recreate this yourself, but not really in the sense, because you've got this Guernsey structured, this Guernsey company, which is tax exempt, plus the ability to roll up the product into the next, so yes and no. I mean, on a mechanical level, I suppose a retail client could potentially go and recreate this yourself if you've got a little bit of knowledge on options, but actually not really, because the structures that you've created really are neat and wrap it up nicely.
I mean, I've both been in this market for quite a long time now. It's one of the things, funnily enough, that a lot of people in financial markets say is, I could just recreate that myself now. And I probably thought that myself 20 years ago. The issue is we're collecting a large amount of money here. Because we've rolled it up 3 times, and this is the 4th iteration, we've got $130 million in this already before new investors come in.
Right.
When you take $130 million and go to one of these banks like Morgan Stanley and say, I want to give you this money for 5 years, there's not a lot of places that you can get 5-year term funding. You would know. So they are paying up for that money a little bit more than what you would be able to get by just going to buy a bond, in the market. We then go to these 8 different banks, and we say we want to trade $130 million worth of options. And that gives us a certain amount of gravitas when we go to, Goldman Sachs, JP Morgan, Morgan Stanley, and we say we've got this big trade. We put them into auction, and the best one wins the trade. So they want to be best price. If you walked in, I mean, I suppose if I was very, very lucky, I could afford to do $200,000. Saved up all my money and put it. And if I phoned up Goldman Sachs and said, I've got $200,000 to trade in options, who can I speak to? I wouldn't get past the switchboard, I don't think. So there's benefits. There's benefits to having that kind of size. And then, of course, you've got the structure as well. Where would you house it? I'd get a piece of paper that says, Goldman Sachs owes me this much money in 5 years' time. And I'd have to start phoning around in 5 years' time trying to get paid. So, there's definitely benefits from doing these, and I've found that there is no better way to do these on a personal basis. So, for example, we here at an Investec bank, we put these together. We're paying advisor fees as well,
Right.
and I can tell you we buy almost all of our products that we put out into the market. So there's value in there for sure.
Yes, absolutely. Absolutely. Okay. And just talk to me quickly about the desk. I mean, you've been at Investec a long time now, Brian. I think, if I'm not wrong, you and I originally met back at Tradec back in 1999, I think it was. So a long time ago. But you've been at Investec a long time, and these structured products, if I'm not wrong, I think guys have done 104 of these in various different shapes and sizes over the last 20 odd years.
So we've done to the public over 100.
Yeah.
70 odd of those have actually expired already. So
right.
Ones that we did for 1 year, 3 year, 5 year. 71 of those over 100 have actually expired, and so we can measure them. One of the problems we had was, people would say, well, what are your returns like? And if you go to one of the big asset managers, they can show you their fund and they show you your benchmark, and it grows over time. We have this. We invested you in the S&P 500 for 5 years, and then we switched it into pounds and we put it into the FTSE, and then we switched it into the Nikkei. So we don't have this easy, to measure graph. But what we have done is, of those 104, 71 of them had expired up until the last week or so, and of those, 100% were all. They all gave capital back as an absolute minimum.
Right.
And even then, 96% of those gave a positive return. So we only had 3 cases where you actually got back just your capital.
Okay.
Now that's a function of a couple of things. One, we had a couple of products running up into 2007, 2008. By 2009, we'd started issuing a lot more. So, markets came off a low base in 2009-10, and we've had very good returns. But similarly, we've also been through the global financial crisis. We've been through the COVID crashes. We've seen inflationary. So the returns we're starting to see over 20 odd years is, we've been very fortunate. We've always given capital back. We've been 96% of the time people have got a positive return. And because we add, in a lot of cases, we add gearing on, our returns are outperforming those markets that we're actually measured against. So sometimes the market's up more than 60%, but sometimes it's only 40% up. We're giving you 60. We're outperforming these markets.
Yeah.
So we've been fortunate in that. Yeah.
I guess it's fantastic. It's a hell of a good hit rate and a very good long-term return. And also, obviously, what you alluded to earlier as well is that not only, can you benefit from the leverage on the upside when markets do well, but also there's that element of capital protection when markets are down. So if you're not losing any money, you're getting 100% of your money back, and the market is down 10, 15, 20% or whatever over that period, well, you're still a hell of a lot better off to then go back into the market with your 100%. So all around, it looks so good. It's fantastic.
Another thing, Garth, that this helps is because not everybody is a disciplined trader, and you would know from teaching trading is not to panic and sell out, or when you see a big dip in the market, correction in the market, it's the time to buy. A lot of people are gripped by that fear, and they actually sell out at the wrong time. And what we find is, because the client has got that, I've got capital protection, they feel they can hold through some of those, through COVID, for example, where we had that very sharp bounce, where, if it was very much a trading instrument, those retail guys might have panicked and sold right at the bottom. So, some of the times it helps that they know, okay, I have this capital protection. I'm in for the long haul. Let's stay there.
Absolutely. All right. And last thing, or second last thing really, is just around the tax. I mean, I know you said that this particular product, this optimal investment growth basket, is domiciled in Guernsey, so that it's in itself is a tax haven. And you can also roll the product into the next iteration of it in 5 years' time in order to defer the tax, etc. But I mean, at the end of the day, if one invests in this product and then exits at some point, how is it taxed? I understand that everyone's tax situation is unique, so maybe it's not a fair question to ask you. But I mean, is this thing going to be treated as capital gains tax or as income tax when one eventually realizes the return?
Yeah, I mean, we as a bank, we can't give tax advice, but what we've seen over time is certainly that what the investor is buying is a share, so it's a listed share. Their intention is, I assume, to hold over the longer term, and they are 5 years in nature. Now, when you buy an offshore share, you don't have this 9C protection that you have for buying South African shares, but it's generally accepted that you're buying a share, you're going to be a holder for the longer term, and you should be on capital account basis that, we've seen that over the years that we've had these products. As I say, the benefit of what the company does is the company in Guernsey pays a nominal amount to Guernsey company. The company itself is not taxed on any of it. It all flows through to the shareholders. So any gains flow through to the shareholders. Yeah. But that benefit of deferring, because you're not selling every time it expires, you have the ability to roll onwards. And because you never sell that share, that would grow, and you'll pay tax at the end of the term for sure. Yeah. But what that tax has the benefit of growing without being taxed in between.
Yeah, you get to defer that tax liability out for the long haul. Yeah. Brilliant. Okay, Brian, it's been really interesting chatting to you about this. I guess the last thing is just to ask you then, if there's somebody listening to this podcast and they are now interested in this product and they want to invest, I mean, I know this particular one has a final deadline date of 24 November 2023. Yes. So that's going to be roughly a month from when this podcast goes out live. How does one get in touch, or how do they go about investing in this product, assuming they've actually got the minimum $12,000 that you're looking for to invest?
Sure. So as I mentioned, you have to go through an advisor. So we're, as Investec Bank Limited, we're only issuers of the product. We're not advisors. We can tell you the details of the product, but we can't advise you whether it's a good buy or not for your particular case. So we do ask people to go through to their advisors, through to their stockbrokers or their wealth managers. The details of this particular product are on our website at Investec Bank. Under the optimal investment basket, and if people do have questions, they're welcome to email through to me, and I can put them onto an advisor if they don't have one, or give them more details of the actual product itself.
All right. Okay, fantastic. I don't know whether you want to give your email address out on this podcast or not.
I'm happy to do that. So it's brian.mcmillan@investec.co.za, and McMillan's MC, MILLA.
Right. Okay, fantastic. All right, Brian, brilliant. It's been interesting chatting to you about this. I've learned a lot having done the research for this podcast, and now also having spoken to you. Very, very interesting product. And I must say, it does make me kind of wish, if I'd gone back 20 years to when you started doing these, that I had put some money into them and just left it. Because as you say, as traders, we all don't always have the discipline to to know when to sell and when not to. Sometimes having that peace of mind of knowing that your capital is protected is actually, it's nice to know. So it's a good product, and it's certainly got me thinking from a personal perspective.
I don't think we had $12,000 when we met in the late 90s. No. We were trading penny stocks.
Yeah, we were yes, we were trading warrants. I was trading warrants because that was all I could afford, and I was learning the hard way about how to lose money on warrants.
Sure.
Super. But it's been great, Brian. Great catching up with you. Thanks for your time. and all the best. Cheers.
All right.
Cheers.
Thanks, Garth.
Bye.
Cheers.
Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.